Diversification, diversifying. Hey, you have to learn how to diversify. All these words, what exactly do they mean? But how exactly do you do it? Very, very important concept, especially when it comes to the markets and investing as a whole. But let's talk about diversification and how to do it. Now, obviously, if you are not new, then how to diversification, this principle does not pertain to you. But this is the Trading 101 series. So yeah, this is just a basic concept, and I want to try to break it down so that people know what exactly is being talked about when they see the word diversification, or you got to diversify, any of those forms of the word, and more specifically, how to do it. Now, I'm not going to tell you how to do it exactly, all the little nooks and crannies, but in a broad sense, that you just understand what's going on and what you're trying to accomplish when you diversify. So diversify, there's kind of two key concepts, and I'm going to summarize those concepts with two key words. The first word is just location. So that's principle number one when it comes to diversification, is just location. And then the second word to keep in mind is size. So two very basic words that I would assume everybody knows what they mean, but these two words summarize diversification as a whole. And I want to walk through a couple different scenarios here and then pretty much kind of quiz you as I go in terms of, is this diversified or is it not? But first, what is diversification? It's just spreading things around. Things can be stocks, things can be business ideas, things can be, if you collect baseball cards. I mean, diversification doesn't just apply to the market. It can be all over the place. I mean, it applies to all things of life, but it means that you are separating things out, again, based on location and size. So what I want to do is just kind of break down, how the stock market works as a whole and look at a few different what are called sectors. And sectors are just different areas of the market. So this will make a little bit more sense to you, but this is where the word location comes up. Within the world of the stock market, there are different locations of things. So for example, we have an area of the stock market where there's companies that do energy. We have another area of the stock market where there's companies that deal in food. We have another area of the market where that's not how, let's see, tech, there we go, Nology. I think that's how you spell it. But there's another area of the market where there's technology. Now there's many different areas of the market. There's many different locations of the market that have different types of companies. But for simplicity's sake and just to illustrate the point, let's just focus on companies that deal in energy, companies that deal in food, and then companies that deal in technology. So real quickly, an energy could be, so just some sort of oil. So there's an oil company out there. Food, we'll just look at McDonald's, all right? So MCD, McDonald's. Technology, the typical one there, Apple. So Apple would fall into that. So these are just kind of examples of, stocks. So this one could be, what's a famous gas station? I don't know, BP. So there we go. Would be the actual company, but obviously an energy company, that would be oil. So these are the different locations of the market. And the first principle in diversification is you don't want to be putting all your money into one location. You want to spread your money across multiple locations. So here's the first quiz question. And let me just do this. So each one of these represents some money. So my question to you is this diversification? If this was my investing, have I diversified my investments? If you're saying, well, no, Clay, because you just told us that you want to spread things across multiple locations. And all you did here was you have 5 dots in the food location of the market and then 1 dot over here in the technology location of the market and 0 dots over here. That doesn't seem like you're diversified very much. Your diversification is lacking because, well, everything is in the food. If that's what you're thinking, then you are correct. Exactly. This is not diversified at all. Diversification would be something more like this. Now maybe you're thinking, well, wait a second, Clay, you only put one in food. True. So is this perfect diversification? Technically speaking, it's not perfect. But the idea here is, notice, things are spread across different locations of the market. Now, on top of this, we need to take things a little bit further. Because yeah, you have dots like that, these areas and the locations, but the size, or what am I referring to size in the stock market? The amount of money. So if each one of these size dots, let's just say represents $100, and then all of a sudden you do something like this, you may be thinking, hey, all right, now you're diversified. You have 3 dots here, you have 3 dots here, you have 3 dots here. If you're thinking, all right, this is diversification, you are wrong in this situation. The reason it's not is, sure, you have 3 separate, as we would call investments, but this investment here is huge. That is a big chunk of money compared to these other areas that you've put in. So sure, you'd have 3 maybe different companies in the food location. That's good from the location perspective. You spread it out. But then from the size of the investment, the size of the amount of money that you've invested, you just put a whole lot more. So in all actuality, your portfolio being the collection of companies that you own, your portfolio would be very heavy now in the food area because you put in a whole bunch of money for this one right here. Now, if something like this happened where it was, you got a big dot over here and then another big one over here, well, then that's where things start to balance out now because at least your money is being proportioned, being separated out more evenly. But you need to be very careful. You don't want to look over the map of, all right, well, yeah, I own 3 food companies, I own 3 technology companies, I own 3 energy companies. There's that extra layer, and the extra layer is here. Well, you got to make sure that, the money kind of matches up. So the easiest way to kind of really look at that is just to assign some numbers. If you have, let's say, to make the math easy, $3,000, then roughly you would want $1,000 in energy, you would want roughly $1,000 in food, and you would want roughly $1,000 in technology. So that's kind of the easy way to, you want to try to keep it as even keel. Now remember, these are just 3. There's more locations within the stock market, but we're just trying to keep the math easy. Now with this though, we'll get a little bit more advanced, and there's even locations within locations. What do I mean by that? Well, within the energy company, let's look at it like this. Yeah, energy, you have oil. But also in energy, you have solar companies. Also within energy, you have, coal companies. They mine coal. So going back to this, would this be diversification? So you want to do 3. So let's just get rid of this right now. So you want to do 3. Now from the top, yes, technically speaking, you do have 3 energy companies. You have 3 food, you have 3 technology. From that perspective, yeah, you're diversified. But let's look a little bit layer down. Hopefully you're thinking, wait a second, no, you're not diversified because the location, within the location, you're not diversified because you have them all in solar. So no, you're actually not diversified. You are kind of, yes, because at least these 3 are in energy. So I'll give credit there, but overall, technically speaking, you're not. And that is correct. You're not diversified in the sense of the different avenues, the different locations within energy itself. So you can definitely have 3 energy stocks, 3 energy companies, but then you got to ask yourself, but what are those 3 energy companies doing? A much more solid approach would be that. Now you are diversified, not only because you have energy stocks, but even within the family of energy, you have an oil, you have a solar, and you have a coal. So that's the one thing that also a lot of people miss out on is they're throwing a bunch of, into technology, for example, but then you look down, they're like, well, yeah, they are all technology, but they all do the same thing within technology. Now, don't get me wrong. It's still good that you have, that's better than having every single stock be in energy. But remember to take a look and be aware of those locations within locations. But that's what diversification is. It is taking locations, spreading your investments out in there, and when you spread it around, it goes back to the whole size thing. If you have $3,000, your goal should be, Doesn't need to be exactly, but you want to keep it relatively close. 1,000 here, 1,000 here, 1,000 there. That's going to keep your size in order. And then you want to just have a good variety of companies that span many different things. So if anybody were asking, hey, how do you diversify? Location, size, that's what it's all about. And then just spread things around. And at the end of the day, if you want to sound really fancy, the whole point of this is you are managing risk. You are hedging risk, because if one sector is doing really well, then hey, you're going to be making some money. But if another sector is not, well, then that one may go down. But that's why you don't have everything in one area. And maybe you've heard the saying before, but you don't want to put all your eggs in one basket. Putting all your eggs in one basket would be putting, all. So again, we have $3,000. All eggs in one basket would be like, you know what? I'm going to put all $3,000 into not only energy stocks, but I'm going to put it all in coal stocks. I mean, now it's either make or break. If coal does well, hey, you're going to do well. If coal doesn't, things are going to get nasty because you did not diversify, and your money is going to get absolutely hammered. So diversification, very, very important, especially when you are investing for the long term. But that's what it's all about, location and size. Keep in mind the location within a location. But at the end of the day, as long as you're spreading around the money in a size proportionate way across different locations, that's the key. That's what you're trying to accomplish when you are diversifying your portfolio.